Welcome, everyone, to the Roth Conversion Garden. I'm Cathleen Davis-Whitmore, and I've spent over 2 decades as a subject matter expert with IRAs, working closely with financial advisors. And yes, I do proudly call myself the IRA Oracle. It is not because I can predict the future of the markets. If I could, I'd be on a beach somewhere. But it's because I have spent years decoding the Internal Revenue Code, so you don't have to. And today, we're going to spend 20 minutes together on one of the most powerful and most misunderstood tools in retirement planning, the Roth IRA conversion. Think of the Roth conversion as planting a garden. You put in the work and pay the tax up front. But if you plant strategically and tend to it right, you harvest tax-free income in retirement. So let's dig in. Here's our plan. For the next 20 minutes, we're going to go through the garden in 5 sections. Think of each one as a different bed in the garden. We're going to start with the soil prep. We're going to move through the growing season, and we're going to finish with the harvest strategy. So let's start with the basics. What exactly is a Roth conversion? At its core, it's simple. You take money that's been growing in a tax-deferred account, a traditional IRA, or an employer-sponsored qualified retirement plan, or I call it a QRP, and you move it to a Roth IRA. So the government says, pay us tax now, and we might leave you alone. There's a few critical facts right out of the gate. First, you need a triggering event to move money from a QRP. What does that mean? That's something like separation from service, retirement. You just can't decide to convert your 401k while you're still working unless that plan offers an in-plan conversion. Second, clients do not have to liquidate their investments. Assets can transfer in kind. So Apple stock stays the Apple stock. It just moves from one account to another. Now, if it's coming out of the plan, again, I have to tell you that the clients have to look at their plan providers and find out what can move and what can't be moved from that account. And third, and this is huge, the conversion itself is not subject to the 10% additional tax. That's for early or pre-59.5 distributions. But here's the trap. If the client's under 59.5 and they take a distribution from the IRA or the QRP to pay for the taxes, that distribution can get hit with a 10% additional tax. So here's my Oracle tip. If you can't pay your taxes from money outside of the IRA, you generally can't afford the conversion. And fourth, once your clients do this, they can't recharacterize or undo it. There's no digging this one back up. Plant with purpose. Now, what if a client's traditional IRA had a mix of before tax and after tax money? I always get asked, well, can't they just convert that after tax money? It makes sense, but the Internal Revenue Code is going to say, whoa, not so fast. Think of it like you're picking grapes. Most of that grape is fruit. And that's your before tax money. But when you bite into it, often there are seeds inside. That's the after tax basis. The Internal Revenue Code is very clear. You can't reach in and just pick only the seeds. Every distribution includes a proportionate amount of before versus after tax. However, this is where it gets interesting because, I love the code. There's always a little something fun under there. If you have a distribution from your qualified plan, not from the IRA, this only works from a QRP, you can separate them. When you get the distribution, you can ask that the before tax amount be transferred or rolled directly to your traditional IRA. The after tax amount to those clients' Roth IRA. Sometimes they send them a check. I always want to say when it comes to the plan, find out the specifics. But they can separate those two amounts and they can go before tax to a traditional, after tax to a Roth. So you're going to separate the fruit from the seed using the Internal Revenue Code rules. That's an Oracle approved move. Okay, so we've planted the money in the Roth. When can they harvest it tax-free? This is what to remember. Roth distribution is either qualified or non-qualified. What's a qualified distribution? It's completely tax-free. And it's when 2 things are met. The 5-year clock for opening and funding the account and age 59.5. Or clients disabled, or for the first-time home buyer exception, and that's a $10,000 lifetime max, or it's paid to the beneficiaries due to death. So what's a non-qualified, and do you owe tax? And the answer is not always. There are ordering rules. What it does mean when it's non-qualified is that the custodian can't confirm it's qualified, so they can't use the code Q that they would. So the 1099-R has a code J. So your client has to figure out if they owe tax or not. And that's where they're going to use the Form 8606, and hopefully their tax professional is going to come in and help them. But now we're going to look at those ordering rules a little closer and cover what it means that they might not owe tax. So we're going to talk about the 5-year planting cycle because there's 2 of them. And they do things differently, and this is confusing. The first is the 5-year clock, determines whether distribution is qualified or non-qualified. The clock starts January 1 of the tax year the Roth was first opened and funded. It's really when they're funded. So think of it this way. We're in 2026. By April 15th, your client made a 2025 Roth contribution. That means their clock started January 1, 2025, ends December 31st, 2029. Now, the second 5-year clock is specific to a conversion. Each time a client converts, that converted amount has its own 5-year period for purposes of avoiding the 10% additional tax. It's only when they're under 59.5. So here's the ordering rules. Because the Internal Revenue Code says when you pull money out of a Roth, it comes in this order. I like to tell you, think of it as a pot. The bottom of the pot, where everything sinks, would be the rocks. The middle is the soil, and the top would be your vegetation. So your vegetation's on top, and that's your contribution. You take out. There's no tax, no 10% additional tax as you put it in after tax. That comes out first. Once that's satisfied, next amounts are any converted amounts. Each in the first in, first out basis, and it's tax-free if they've met that 5-year holding period, if they're not 59.5. Last are earnings. Those are the rocks that sunk to the bottom, and it's the most restrictive. It has to meet 2 requirements. 5 years, that original 5-year clock we talked about, and age 59.5, or if the client's disabled, they're the first-time home buyer exception, or due to their death. So that layered structure is actually great news for most people. If they've been contributing for years, they can always pull those contributions on a tax consequence at any time. All right, now let's talk about anyone voluntarily write a check to the IRS today. But I have 6 compelling reasons for you. One is tax-free retirement income. The tax is paid now at a known rate, and every dollar in that Roth has the potential to grow and come out tax-free. Second, there's no RMDs, no required minimum distribution. It's huge for wealth building. Traditional IRAs force the owners to take money out starting at RMD age, whether they need it or not, and it creates a taxable event. Roth IRAs have no RMDs during the owner's lifetime. 3, let's talk about Social Security and IRMA management. For clients with significant RMDs coming, a Roth IRA can reduce for future taxable income that a traditional IRA would create, which determines whether the client's Social Security is taxable or at 50 or 85%, and whether they pay higher Medicare premiums through the IRMA surcharges. 4th is legacy planning. If your clients have beneficiaries who inherit retirement accounts, a Roth IRA is a profound gift. Most non-spouse beneficiaries only get to keep the inherited IRA open for 10 years. With a Roth IRA, that would be 10 years of tax-free growth potential. And now remember, a spouse can always treat the deceased spouse Roth IRA they inherit as their own, no RMDs for them. 5, geographic arbitrage. If your clients live in a no-tax state today, but are retiring to one with taxes in the future, convert now while the state tax is 0. And 6, estate planning. The Roth IRA is one of the most efficient assets to leave behind. Tax-free compounding, plus tax-free inheritance. It's a win-win. Now, here's something a lot of financial professionals don't spend enough time on, but the Oracle will. When should you not convert? I want you to walk through some big ones so you can go over them with your clients. If your client cannot comfortably pay the conversion tax from outside money, don't do it. Remember, this is permanent. If they have to sell investments, or deplete savings to pay the tax, that destroys the very benefit they're trying to capture. If the conversion pushes them into a meaningfully higher tax bracket, they might be paying 32% today, but they'll pay 22% retirement, they shouldn't be doing it. If they're leaving a state, a tax, to a no tax state, they're leaving a state they have to pay tax in to go to a no tax state, either now or in retirement, you might want to wait until they move. If their beneficiaries are in a lower tax bracket than the owner, maybe that traditional inheritance is still okay. Remember, charities don't pay income tax. If the charity is the beneficiary, keeping the traditional IRA is perfectly tax efficient. And don't forget the triple trap. If IRA assets are used to pay the conversion taxes, then they get hit with income tax on that distribution. They lose tax deferral on their amount, and they might owe the 10% additional tax. Triple whammy, let's not do that. And finally, remember, the RMDs cannot be converted. Once clients reach RMD age, the first amounts out are considered the RMD, and they are not allowed to be converted. So that comes off the top, and what's left be converted. Now, before I leave the caution zone, I want to make sure you know some other exceptions to 10% additional tax. So even if the distribution doesn't meet the qualified tax, the additional tax may not apply. And the list includes 59.5, death, disability, eligible medical expenses, certain health insurance for certain unemployed individuals, the first-time homebuyer exception up to the lifetime maximum of $10,000, qualified higher education expenses, substantially equal periodic payments, the conversion itself, reservist distributions, birth or adoption expenses up to $5,000, and IRS levy. Now, this list can be a lifesaver for clients who need to access funds early, but you always need to check with the IRS website for the full current list. This is one area where the rules do evolve. So how do you know if a Roth conversion is right for your particular client? Well, the Oracle's framework comes down to 3 questions. 1, can they pay their taxes from outside the IRA? If yes, they preserve every dollar inside the Roth for compounding. If no, you should probably stop digging there. 2, is their tax rate today at or below what they expect in retirement? If they're in a low bracket year, or maybe they just retired, or they had a gap year in income, that's a planting window. If they're at peak earning and won't be in retirement, maybe you should wait. And 3, will the money have time to compound? 10 or more years of tax-free growth makes conversions dramatically more powerful. Shorter horizons are going to reduce the benefit. And if beneficiaries will inherit soon, factor in their bracket too. 3 questions. It's not a formula. It's a framework. Because remember, every garden is different. So here is your quick desk reference, my Oracle desk reference, if you would. And here's some highlights. No income limits on conversion. Anyone can do this. The conversion itself is not subject to the 10% additional tax, but it cannot be undone. RMDs cannot be converted. You have to take that first and convert whatever's left. And remember, the assets can move in kind. Your clients don't have to liquidate. So you can take a screenshot of the slide, share it. It covers the questions I get most often. So let me leave you with 3 seeds to take home. Seed 1, a Roth conversion is irreversible. Make decisions from clarity, not fear of taxes. Understand the cost, understand the benefit, and plan intentionally. The seed 2, the 5-year planning cycle and the ordering rules are your map. Know them, print them, keep them as a desk reference. Seed 3, no 2 financial gardens are alike. The question isn't whether Roth conversions are good, it's whether they're right for this person in this season of their financial life. So I'm Cathleen, the IRA Oracle, and this has been your garden tour of Roth conversions. Thank you for spending a few minutes with me today. Now, go plant something.